credit card feels simple. Tap, swipe, insert. No cash leaves your hand, no money visibly disappears. The transaction is instant, effortless, frictionless. Rewards accumulate, points grow, miles promise vacations. The card feels like access. But behind that small piece of plastic exists one of the most profitable financial ecosystems in modern history. In the United States alone, credit card debt exceeds $1 trillion. Major issuers report billions in annual profits. Networks process trillions in transaction volume. And yet most users believe the business model is simple. You borrow money. You pay interest. That's how they earn. But that explanation is incomplete. Because even when you never carry a balance, someone is paying. Even when you earn rewards, someone is funding them. Even when you avoid interest, you are still participating in a revenue machine. Tonight, we are not asking how to avoid debt. We are asking what is the real business model of credit cards and who ultimately funds the system. This is the economic code. A credit card transaction involves more than two parties. It is not just you and a bank. It is a four-party system. The cardholder, the merchant, the issuing bank, the network. The two dominant networks are Visa, MasterCard. These companies do not lend money. They operate payment rails. When you tap your card, the merchant sends transaction data. The acquiring bank processes it. The network routes it. The issuing bank approves it. All within seconds. The transaction appears seamless. But money moves in multiple directions, and at every step, a fee is extracted. Most consumers never see interchange fees, but merchants do. When you spend $100 at a store, the merchant does not receive $100. They receive approximately $97 to $98. The difference? Interchange. A fee paid to the issuing bank. It typically ranges from 1.5% to over 3% depending on card type. Premium reward cards often carry higher interchange rates, which means your rewards are not funded by generosity. They are funded by merchants, and merchants adjust prices accordingly. This means even customers who pay cash subsidize credit card rewards. The ecosystem redistributes costs quietly. Not all cardholders are equal. Issuers divide customers into two broad groups. Transactors pay full balance monthly, avoid interest. Revolvers carry balances, pay interest over time. Revolvers generate the majority of profit. Interest rates often exceed 20%. Risk-based pricing adjusts APR depending on credit profile. The ideal customer for an issuer is not someone who defaults. It is someone who carries a balance consistently, but remains solvent, almost maxed, but never collapsing. This is not accidental, it is risk modeling. Sophisticated algorithms predict likelihood of repayment, spending behavior, income stability, life events. Data science optimizes profitability. Rewards programs are not perks. They are behavioral design tools, points, cashback, miles, sign-up bonuses. These incentives encourage higher spending, category targeting, brand loyalty, card retention. Psychological principles involved: variable reward schedules, dopamine reinforcement, sunk cost bias, anchoring gamification. Premium cards create identity signaling. Metal cards, exclusive lounges, tiered status systems. Spending becomes aspirational. The card becomes part of personal branding, and higher interchange fees fund richer rewards. A loop forms. More rewards leads to more spending, leads to more fees, leads to more profit. Credit card receivables are not just held on bank balance sheets. They are often securitized. Issuers bundle outstanding balances into asset-backed securities. These are sold to investors. Investors receive payments funded by cardholder interest and fees. Risk is distributed. Liquidity increases. Capital is freed to issue more credit. Debt becomes an investment product, which means credit cards are not just consumer tools. They are components of capital markets. This is how the ecosystem scales. Let's map the flows. Merchants pay interchange. Revolvers pay interest. Late payers pay penalties. Annual fee customers fund premium perks. Networks earn assessment fees. Issuers earn interest plus interchange. Processors earn service fees. But the hidden layer is price inflation, because merchants factor processing costs into retail prices, meaning the system is partially funded collectively. Even non-users contribute indirectly. This redistributive structure is rarely discussed. Why does the system endure? Because incentives are aligned. Consumers gain access, merchants gain sales, banks gain revenue, networks gain scale, investors gain yield. Even regulators often avoid radical disruption. During crises, liquidity support protects financial institutions. Because the payment system is considered critical infrastructure. The machine is deeply embedded. It is not fragile, it is adaptive, and it evolves with technology. Contactless payments, digital wallets, embedded finance, BNPL hybrids. The form changes, the structure persists. Credit cards are not merely debt instruments, they are behavioral platforms, revenue engines, data collection systems, capital market conduits. The illusion is simplicity, the reality is infrastructure, and the most profitable part of the system is not default, it is sustained participation. The economic code is not about rejecting the system, it is about understanding your position inside it. Because once you see the flows, you stop asking whether the system works, and start asking who it works best for. This is the economic code. Like, comment, share, and subscribe for more investigative videos on the hidden systems of money, power, and financial institutions.